Hello there. Do you know there's a way to make your money work for you without all the stock market drama? Let me introduce you to a super chill investment that's been around forever: bonds. Yes, you might not get rich overnight, but it's perfect if you want a safe, steady growth of your hard-earned cash. Let's break it down. So, what are bonds? Bonds are basically loans that you give to either the government or a company. They promise to pay you back with interest after a specific period. It's like you're the bank, but without dealing with all those complicated forms. It's a safe investment option, and if the stock market feels like a roller coaster ride, think of bonds as the peaceful Ferris wheel of investments. Lower risks and more predictability. How do bonds actually work? Imagine you lend 10,000 rupee to the government through a bond, and they say they'll pay you 6% interest every year. So, every year, you get 600 rupees, and after the bond period ends, you get your 10,000 rupee back. Sweet deal, right? There are two types of bonds available in India. Government bonds. These are issued by the Government of India, and they're as safe as it gets. Corporate bonds. These are issued by companies, and they carry slightly more risk but also offer higher interest. Why should you invest in bonds? For stability. Unlike stocks, where prices can swing wildly, bonds are predictable. You know exactly how much you'll make. For diversification. Bonds can help balance your portfolio, especially when markets are volatile. For regular income. Bonds are great if you want a consistent income flow, like for retirees or for anyone just wanting peace of mind. What are the risks associated with bonds? There is credit risk. The risk that a company might not pay you back, which is why government bonds are safer compared to some corporate ones. And there is interest rate risk. If interest rates go up, the value of your existing bond might go down because new bonds are more attractive. What are the tax implications in buying bonds? The interest from most bonds is taxed, except for specific tax-free bonds. Also, if you sell your bond before maturity and make a profit, you may be liable for capital gains tax. Long-term capital gains, held for more than 3 years, have lower tax rates. What are pros and cons of investing in bonds? Pros: it is safe, gives steady returns, and a predictable income. Cons: it generally gives lower returns compared to other investments like stocks, especially when inflation is high. So in conclusion, should you invest in bonds? Bonds are a solid choice if you are looking for stability and don't want sleepless nights worrying about your investments. They might not make you rich quickly, but they'll definitely help you sleep soundly knowing your money is in a safer place. Thanks for sticking around. If you found this video helpful, don't forget to give it a thumbs up and subscribe for more easy-to-understand financial content. Let me know in the comments, are you a fan of the slow and steady approach with bonds, or do you like the thrill of the stock market? I'd love to hear your thoughts.